which require a complex calculation. Exhibit you can see in a requirement tab. Why Mr. Linonix is believing it. Okay, welcome back. So now we have part B, and in part B we have first question, question number 3. In this question we have multiple accounting standards. One is bundled good. It is I think it would be IFRS 15. Discontinued operation IFRS 5. Land IS 16 or IS 40. Option to purchase a building. Describe the purchase of an option. So multiple accounting issues we have in this question. Now, just read the requirement. First, we will do exhibit 1, bundle of goods. And the requirements relating to the first exhibit is using exhibit 1 and in accordance with IFRS 15, revenue from contract with customer, discuss with C company should allocate the transaction price to the hardware package sold to head company, and show all calculation. So we need to allocate the transaction price and to the hardware package which has been sold to heat company, and we need to show all the calculation. All the calculation. So that is the requirement. And now we have the exhibit. And let me enlarge it. Okay, this is the exhibit number 1. Kindly read this exhibit. Read it. So C company entered a contract with customer heat company to sell a hardware package comprising a computer, a monitor, and a printer for $2,000 US, with $2,000 US. C company will supply each of the three products at different points in time according to the need of the customer. C company regularly sells computers separately for $1,720 US. However, the monitor and printer are new models and are not yet sold. Separately. So these are the new products. Before this, they haven't sold it separately. C company knows that competitor companies sell similar specification of a printer for $180, which C company feel reflect entity cost and margins. The cost to produce a monitor is $150. C company achieve a gross profit margin of 25% on selling price of its product. 25% margin on selling price. So the question requirement was that how we will allocate the transaction price. Now, dear students, if I can guide you for this question, you need a knowledge of IFRS 15, IFRS 15, Accounting Standard of Revenue. In IFRS 15, there is a step number 4. The step number 4 talk about the allocation of transaction price. Allocation of transaction price. Now, let me tell you one thing. At the start of the this session, I told you that keep yourself in limits as per the requirement. Now, in this question, the examiner is just asking about how to allocate the transaction price, which is the step number 4. Examiner is not asking us to discuss about what is revenue, what is the step number 1, identification of the contract, what is the step number 2, identification of the performance obligation, what is the step number 3, determination of transaction price. Examiner is not asking about these things. Even examiner is not asking about revenue recognition, that whether revenue recognition should be at a point in time or over the time. The examiner is just asking about only one thing: how to allocate the transaction price among these 3 performance obligations. Number 1, we have a performance obligation of a computer, then monitor and a printer, and the transaction price is $2,000, which the examiner asking us to allocate. Now, to allocate the transaction price, IFRS 15 is very clear that it should be done on the basis of stand-alone prices. It should be done using the stand-alone prices. The standalone price is the price at which, if these goods or services are sold separately, what price company would have charged. That price is known as standalone price. So the transaction price, which is $2,000, should be allocated between computer, monitor, and printer on the basis of the standalone price. The $2,000 should be allocated as per the standalone price. Now, the standalone price, as per the guidance of the IFRS 15, should be observable. Means there should be identifiable standalone price. Like here, for computers, we have 1,720 is a standalone price. Its standalone price. Computer standalone price is identified. Okay, that is identifiable, that is observable, directly observable. But the problem is with the monitor and with the printer. The problem is with the monitor and with the printer. The stand-alone price of the monitor and a printer is not directly observable. This is a problem. Now, where the standalone prices are not directly observable, then as per IFRS 15, we have to estimate the standalone prices. If the standalone price is not directly observable, is not directly identifiable, then we have to allocate, then we have to estimate it. So for monitor and printer, we will estimate the standalone price. We will estimate the standalone price. We will estimate the standalone price. Now, to estimate the standalone price, again, the guidance will come from IFRS 15, step number 4. We can use a market assessment approach. Market assessment approach. We can use cost plus approach, and we can use residual approach. Now, in this scenario, the residual approach is not possible. Is not possible. Is not possible. And residual approach is not an approach which is recommended, okay, which is recommended. So we are now left with two approaches, market assessment approach and cost plus approach. Now, what is a market assessment approach? Market assessment approach means, and keep in mind, while using this approach, IFRS 15 suggests we use maximum observable input. We use observable input. Observable inputs mean the inputs which are coming from independent source. Now, the market assessment approach is that we should determine that simply at what price, if possible, at what price our competitor is selling the products or services. Like in our question, for monitor, we can use a market assessment approach. Because in the question it is mentioned, sorry, for printer, for printer, we can use market assessment approach, where we have an information that one of our competitor is selling a printer at 180. So now we have standalone price of a computer, which is 1720. We have a standalone price of a printer, which is 180. So now we left with only standalone price of the monitor. Now for monitor, in this question, we can use a cost plus approach. We can use a cost plus approach. In cost plus approach, we will estimate that what would be the cost of the product, and we will adjust that cost with our markup or our margins. Now here, we have estimated that cost to produce a monitor is 150. And we normally charge 25% margin on the sale price. So for monitor, we know the cost is 150. Now in margins, cost is representing 75% of the sale price, because margin are 25%. So divided by 75 into 100. Divided by 75 into 100, you will get the estimated standalone price of the monitor, which is $200. This $200 is cost plus approach. Now, dear students, we have standalone price, 2100 in total. 2100 in total, we have a standalone price. We have a standalone price of 2100 in total. Now, what we need to do, we have discussed that how a transaction price will be allocated as per the standalone price. What is the standalone price? We have discussed that thing. We have discussed that standalone price which is observable is of a computer, which is 1720. For monitor and for printer, we have to estimate it. using the market assessment approach and using the cost plus approach. According to market assessment approach, the printer set standalone price should be 180, and according to cost plus approach, the standalone price of the monitor should be 200. Now, if when we have discussed all these things, now the final step will arrive where now we have to allocate. Now we have to allocate the transaction price amongst the performance obligation. And transaction price is 2000. Now this 2000 need to allocate among computers, monitors, and printer. Now for the computer, the allocation price will be 2000 divided by 2100 into 1720 into 1720. Total transaction price divided by total standalone price multiply by the individual standalone price of the computer, and you will get 1638. That would be the standalone price, the allocated transaction price of the computer. Then for monitor, again, total transaction price divided by total standalone into 200. Into 200. You will have 171. I am rounding the figure, that will be 171. And then for printer again 2000 divided by 2100 into 180. And here you will be having 191. So this is how you will allocate the transaction price among the different performance obligations. So in this exhibit, the focus was on the step number 4 of IFRS system. An examiner is requiring just to discuss that step. Okay. If any candidate go beyond that, like if the candidate is discussing the definition of the revenue, if the candidate is defining that step number 1 is contract identification, then he is defining the performance obligation, distinct performance obligation, then he is defining transaction price, and then he is discussing the allocation of the transaction price, and then discussing the revenue recognition. Then believe me, you are going to get only the marks which is relating to the step number 4. The other thing which you are discussing, you are just wasting your time. You are just wasting your time. So keep yourself in the limits of the requirements which are required by the examiner. Do not go beyond the requirement, because going beyond the requirement, you are going to nothing. You are going to get nothing. You will get no additional marks. So keep yourself under the requirements in an exam. And again, in this exhibit, the requirement was only, let me show you again. Now it would be easy to relate. The requirement was only that using the exhibit 1 and in accordance with IFRS 15 revenue contract with customer, discuss how C company should allocate the transaction price to hardware package sold to heat company and show all calculations. Okay, so it is just focusing only on the step numbers, only on the step numbers. So this is a proposed answer which I have already written. And look at what points we have discussed. Number one, simple. C should allocate transaction price in proportion to the relative standalone selling price. Then he is defining the standalone price. This is the price at which an entity would sell goods or services on a separate basis at a contract inception. And IFRS 15 state that the observable price of a good or service sold separately provide a best evidence of the standalone selling price. And if the standalone selling price are not readily available, then we have to estimate it. And in this case, then he's relating this knowledge that the computer standalone price 17220 is directly available, but the standalone price of the printer and the monitor is not directly observable, so we have to estimate it. And in that estimate, you can use market assessment approach, you can use the cost plus approach. Then they are defining little bit market assessment approach and the cost plus approach, and then they are applying that knowledge that the printer can be measured at market assessment approach, which is given at which competitor is regularly sell is 180. And for monitor, they are using cost plus approach. The cost to produce a monitor is 150 and company normally charge 25% margin. So the standalone price of the monitor is 200. Then the total standalone price is 2100. And then using this 2100, they are allocating 2000 among the computer, monitor, and printer. So again, we have a short time, but again, if you have a knowledge and if you have a skill to apply that knowledge, that is enough to pass the SBR exam, sufficient to pass SBR exam. Now we have the exhibit number 2. And the requirement relating to exhibit 2 is using exhibit 2 in accordance with IFRS 5, non-current asset held for sale and discontinued operations, discuss whether the profit on the sale of the license should be presented. Discuss whether the profit on a sale of the license should be present. Now keep license is a single asset. Should be presented as arising from a discontinued operation in a statement of profit and loss. So this question is surrounding around the IFRS 5, and in IFRS 5, they are talking about the discontinued operation. Now, what is discontinued operation? We first of all, you need to aware of that when we say a discontinued operation, what is the meaning of discontinued operation? Now, if the student knows the definition of the discontinued operation, then I think this question is going to be very easy question. Very easy question. If student knows about the definition of a discontinued operation given in IFRS 5, then it would be a very easy question. Now, what is the definition? Definition. Now, the definition of the discontinued operation, I will write in steps. Number one, discontinued operation is basically a component of the entity. Number one, a discontinued operation is the component of the entity, first of all. Now, what is the meaning of the component of the entity? Now, dear student, component of the entity means that might be a reportable segment. Reportable segment as defined in IFRS 8, or that might be an operating segment, That might be an operating segment, or that might be a cash generating unit, or that might be a cash generating unit, maybe a CGU, maybe a CGU, cash generating unit. So first of all, it should be a component. It should be a reportable segment, it should be an operating segment, or it should be a cash generating unit or multiple cash generating units. And then that component has been disposed or held for sale, So it should be a component of the entity, and that component of the entity has been disposed, or that component of the entity has been held for sale. First of all, now after when you have established that is a component of the entity, and that component of entity has been disposed or has been classified as held for sale, then the next step is that component of the entity is representing, number one, representing a separate major line of the business or geographical area. Geographical area. Separate major line or a geographical area. Like for example, your company is involved in number of businesses. Like one of their reportable segment is a dairy farming. One of their reportable segment is relating to mineral water. One reportable segment of there is relating to confectionery. Now, if they decide to dispose of, or to decide to classify held for sale, one of the major line of their business, maybe they decide that they are going to seize the dairy farming business, and that dairy farming business is representing a major line of the business, means a material part of the business, or they are going to discontinue their major line of a business from a geographical area, then that component can be a discontinued operation. Number one, separate major line of a business or a geographical area. Number two, or that is a part of single coordinated plan to dispose of a separate major line of the business or separate part of geographical area. Geographical area. Or if first of all, it should be a major separate line of a business or a geographical area, or is a part of single coordinated plan. That is part of a plan, coordinated plan, that you are going to dispose of your major line of a business, or you are going to dispose, or you are going to exit a major separate geographical area of your operation. If that is a part of a single coordinated plan, that is also presenting a discontinued operation. And number three, or it's a subsidiary. It's a subsidiary acquired with the view of resale, or it is a subsidiary which you have acquired with the view of resale. That will be a discontinued operation. So redefining the definition, discontinued operation is a component of the entity. That component of entity mean again reportable segment, operating segment, or maybe a multiple cash generating unit or a cash generating unit. And that component of entity has been disposed of or has been classified as held for sale. And that component of entity is representing a separate major line of a business or geographical area, or is a part of single coordinated plan to dispose of a separate major product line or a geographical area, or it is a subsidiary acquired with the view of resale. If the license is presenting a component and that component is come under one of these three criteria, then you can say the license is presenting a discontinued operation. Otherwise, license is not a discontinued operation. So now, keeping this whole story in mind, now if you read this given exhibit and then we discuss that whether that is a discontinued operation, selling of a license is a discontinued operation or not. Now during X7, C company purchased and then subsequently sold a license. Sold a license. The income it generated was small in context, is small in context of overall business. And C company regularly buys license with a view to reselling them. At any point in time, it owns several software licenses. The profit on the sale of these licenses was presenting as arising from discontinued operations in a statement of profit and loss for the year ended December X7. This was because C company believed that license was a separate component of the business. Separate component of the business. Okay. Now, one by one. Let's say, yes, if we believe that is a separate component of the entity. Number one, that is small in context as compared to overall business. So it is not presenting a major line of a business or a geographical area. Neither it is part of the single coordinated plan where we are going to dispose of a major line of a business or a geographical area. Okay, so it fails first two characteristics of the discontinued operation, which should be met in order to classify a component as held for sale. And number three, it is a license. License is not a business. So you can't say that the license is a subsidiary which you have acquired with the view of resale. Are you getting it? License is not a subsidiary. Now, in the third thing is that component should be a subsidiary which acquired with the view of resale. You are acquiring license with the view of resale, but the question is that whether the license is a business. No, license is not a business. It is your ordinary activity that you purchase the license, you purchase the software, and then you sell the software. So it is part of your normal trading. It's not your license, is not your business. It's not your major product line. So the sale of that license, the disposal of that license, or a gain or loss on the disposal of that license cannot be presented. Dear student, it cannot be presented as a discontinued operation. It should not be presented. It would be inappropriate to present the sale of license and a gain or loss on a sale of license as a discontinued operation as per IFRS 5. IFRS 5. So that was relating to the IFRS 5 and the total marks of this requirement were 7. Now, you can say defining components would involve 1 marks, defining discontinued operation would involve two marks, and application of that definitions on a given case study that whether the license can be classified as a discontinued operation would involve 3 to 4 marks. So that would be the allocation of the marking on this requirement. Then after this exhibit, we have an exhibit relating to a land. Again, before we read the exhibit, let's go through the requirement. And the requirement is using the exhibit 3, discuss how land and its fair value should be accounted for in the year ended 31st December X7. For the year ended 31st December X7. So you have the exhibit. Kindly read it. Okay. On 31st December X6, C company acquired a land for 10 million. They have acquired a land for 10 million. The intention was to turn it into an employee car park. Was to turn this land into an employee car park. Employee car park. Employee car park means that your intention was to use this land to use in business, and any property which you purchase to use in a business is known as owner occupied property, owner occupied property, and the relevant standard is IAS 16 property, plant and equipment. The cost of this land was recorded as a property, plant and equipment. Yes, they were right. It should be treated as a property, plant and equipment. By 1st December X7, the land had not been developed into a car park. Many employees had started working from home, meaning that the car park was no longer required. So the C company decided that it would lease this land instead. So they have decided to lease the land. Now, if the lease is an operating lease, if it is an operating lease, and normally in case of land, the lease is always an operating lease. For in case of land, normally the lease of the land is always an operating lease, unless at the end of the lease term, you are going to transfer the legal title. You are going to transfer the legal title. Okay. Otherwise, the land usually treated always as an operating lease, and it is nothing mentioned, then it is presumed that it is an operating lease. It is an operating lease. And if it is an operating lease, that means now the standard would be investment property IAS 40. Investment property IAS 40 will be the accounting standard, and that would be the transfer, and it will be a transfer. Keep in mind, it will be a transfer from IS 16 and IS 40. And now, student, very easy marks. This is the topic of FR, financial reporting. It is a carry forward knowledge which we are bringing from FR, and it is totally depend on the paper of FR. Okay, so it is a situation where a property, plant and equipment, a property which was an owner occupied property, which is being classified as under IS 16, is now being transferred from IS 60 to IS 40 because the change, there is an change in objective to hold a property. Or you can say there is a change in use of a property. The property which was held for use in a business is now held for rental purpose. And when your purpose to earn the rental from a property, then that property cease to be an owner occupied property and start to be considered as an investment property. So it is a transfer. It is a change in use. So a property from IS 16 is going to transfer from IS 40. Now the rule is that on the date of transfer, you will apply the previous standard. Like for example, I don't know if when we read further case study, if in IS 40 they are using the fair value model. If in IS 40 they are using a fair value model to keep the investment property, then before we transfer that property into IS 40, first we will revalue the property. First, we will revalue the property in IS 16. And if there is any gain, let's say if there is any gain, that gain will be treated under other comprehensive income and revaluation reserve. That gain would not be reported to profit and loss because in investment property, gain and losses are reported directly in profit and loss. But this gain will be treated as per IS 16 and will be reported in other comprehensive income. Subsequently, if there is any change in fair value, that change in fair value would be reported as per IS 40. As per IS 40. And that will be reported in profit and loss account. Okay. Now, read the further detail. C company classified the land as an investment property and measured it at original cost of 10 million. C company wished to use the fair value model in IS 40. However, as at 1st September X7, C company believed that it was impossible to measure the fair value of the land due to legal complication concerning public access. A nearby plot of land of a very similar size with a similar legal complication sold in September for 11 million. Okay. On December X7, legal issue were resolved. C company hired a surveyor who stated that it had a fair value of 11.5 million. C company calculated the fair value gain of 1.5 million and a difference between 10 and 11.5 million they have recognized in profit and loss. So the issue here, they have treated the total gain of 1.5 million, which is a difference between 10 and 11.5 in profit and loss account. Now, dear student, now if we write the answer of this question, I would be writing that they have purchased this land on December X7 and they have rightly classified that land under property, plant and equipment because the purpose of the land is to use the land for a car parking part for the employees. So their classification was right and they rightly recognized that land under IS 16 property, plant and equipment. But on 1st September X7, when there is a change in use, because on 1st September X7, they have decided that they will give a land on a lease. And as I told you, the land is always an operating lease. So it will become an investment property and IS 40 will become applicable. Now in IS 40, there is a choice of accounting policy that whether you are going to use a cost model or are you going to use a fair value model. And if you are using the fair value model, keep in mind, all the investment property should be measured at fair value. Now, you are going to use cost model only if the fair value is not reliably measurable. Then the entity should use the cost model. Then there is no other choice. But fair value is not reliably measurable or cannot be measured reliably. It is a very rare case. It is a very rare case. It is exceptional case when you can claim that we cannot measure the fair value of the property reliably, because it is rare. That due to the nature of the property, due to the nature of the real estate, the fair value are readily available for the properties. Okay, because real estate is a sector where you can measure the fair value of the property in any part of the world. Okay, real estate, such a you can say a strong characteristic or a demanding sector where the fair value measurement is not a problem. And it is mentioned in a question that in a same locality with the same legal dispute, there is a property which has been disposed of, which has been sold for 11 million. So that means the market participants can measure the fair value. Now here IFRS 13 become relevant. Now, because we are discussing the definition of the fair value, we are discussing the fair value investment property. So IFRS 13 will automatically involve. You need to create a linkages as well. And as per IFRS 13, the fair value is not the entity specific value, that what entity is taking. The fair value is the value which is coming from the market participant. And from the market participant, the fair value is coming, and that is 11 million on 1st September. So the fair value is readily available. So on 1st September X7, this property should be measured at fair value at 11 million. But before we transfer, we should determine the fair value under IAS 16, which is 11, and we have a cost of 10 million. And fair value of 11 million and cost of 10 and fair value of 11. So on the date of transfer, there is a gain of $1 million. And this gain should be reported in other comprehensive income, because it will be measured at fair value before we transfer it. So 1 million gain should be reported in other comprehensive income. Yes, the subsequent gain, you have measured the property on 1st September at 11, and at the year end, the fair value is 11.5. There is a further gain of 0.5 million, and that gain should be reported as per IAS 40 in profit and loss account. Okay, so again, for this question, a part of the question, you need the knowledge of IAS 16, you need the knowledge of IAS 40, and in IAS 40, you need a knowledge of fair value model of IAS 40, and then you need a knowledge of IFRS 13 fair value measurement. You need to create a linkage here, because the fair value is a terminology which we are using. So to determine the fair value, you need to refer towards IFRS 13. And one thing again, the question requirement is how to account for the fair value. Keep in mind, the requirement was how to account for the fair value. Examiner is not asking you that what is investment property. Okay, what is investment property? Define investment property. What is the accounting under fair value model? Under the fair value model of investment property. He is not asking. He is just asking what would be the treatment of fair value gain on this property on the date of transfer and subsequently. Yes, while discussing, you need to discuss to some extent what is the investment property. Not need to define the investment property. You just need to identify that when our purpose is to earn rental now by giving the land on an operating lease, then it should be an investment property under IAS 40. And it should be transferred from IAS 16 to IAS 40 because there is a change in the use of a property. there is a change in the objective to hold a property. And then you need to discuss the fair value treatment on the date of transfer and fair value treatment subsequently. So on the date of transfer, there is a gain of 1 million, which should be reported in other comprehensive income. And after that, there is a gain of 0.5 million, which should be reported in profit and loss account. And what the thing they are doing wrong, they are treating total 1.5 million gain in a profit and loss account. So 1 million gain should be reversed from profit and loss and should be reported in other comprehensive income. So that was the third exhibit of the question number 3. Now, the next exhibit is option to purchase a building. And kindly read the requirement. Using the exhibit 4, discuss how the payment made to acquire the option should be accounted for in the year ended 31st December X7. On 31st December X7, how it should be accounted for. The payment to acquire an option. Now, what is the exhibit and what exhibit is saying to us? Let's read it. The functional currency of C is the dollar. On 1st December X7, C paid 1,000 dinar to a property developer for an option to purchase a building. So, the functional currency is dollar. Keep in mind, the functional currency is the dollar, and they are paid an amount of 10,000 dinar to a property developer. So, it is a foreign currency. So IS 21 will also be relevant here. A little bit. To property developer for an option to purchase a building situated overseas at a fixed price on 1st July X8. The payment to the property developer is non-refundable. C company believes that it is highly probable that it will purchase the building. It is highly probable that it will purchase the building. It will purchase the building. C company proposes to treat the contract as a derivative financial asset measured at fair value through profit and loss in a financial statement for the year ended 31st December X7. And the requirement is how to treat this payment. Now, there are two standards which are relevant. One is IFRS 9 because they are treating it as a derivative. And derivative obviously measured at fair value through profit and loss account in IFRS 9. And the second is IS 21. Now, let's talk about, first of all, the relevancy of IFRS 9 here. Dear student, derivative contracts treated under IFRS 9, and especially those derivative contracts which are relating to non-financial assets like a property. Property is a non-financial asset. Now, according to IFRS 9, a derivative on non-financial assets is not a financial instrument. I am saying again, is not a financial asset or financial instrument, or in other words, it is outside of IFRS 9 scope. If The intention is to take the physical delivery of that asset. If your intention is to take the physical delivery of that asset, your intention is not to settle that derivative contract on a non-financial asset on net basis, on a gain or loss basis. But instead, the intention is to take the physical delivery. Means in this case, you have an intention to purchase the property. Then that derivative contract is not under the scope of IFRS 9. Keep in mind. And now if you apply that knowledge on this given case study, they have the intention. They have clearly mentioned that they have an intention and it is highly probable that they will purchase the building. So they have an intention to take the physical delivery. So this derivative contract is not a financial instrument. It is outside the IFRS 9. Be clear. It is not under IFRS 9. It should be recorded as a advance payment. It is not a derivative contract. It is the advance payment. And it should be recorded as an advance payment. It is not even a property at the moment. You will recognize only an advance payment against the property. It is not property, plant and equipment. It is not investment property. It is not a derivative contract. It is just an advance payment which you have paid to purchase a property. So it will be recorded as an asset. And in asset, it will be recorded as an advance payment. It will be recorded as an advance payment. Okay. So that would be IFRS 9. That would be IFRS 9. Now, after IFRS 9, there is another standard which is relevant here, IS 21, which is relating to foreign exchange rate, or you can say the impact of change in foreign exchange rate, IS 21. Now, as you know that this $10,000 dinar is not in our functional currency. Our functional currency is the dollar. So first of all, as per IS 21, this 10,000 dinar should be translated into dollar on initial date, which is the 1st December X7, using the spot rate of 1st December X7, this 10,000 dinar should be translated into dollar. Now, what is the exchange rate? We have no idea. We just mentioned that the exchange rate of 1st December X7 should be used to translate these 10,000 dinars into the US dollar to record this transaction in a financial statement. Number one. Number two, this advance payment which we have made is a non-monetary asset. Is a non-monetary asset. It's not a monetary item. Monetary assets are those which are readily convertible into cash, and it is an advance to supplier. It is an advance to supplier, and it is not refundable. So it is not a monetary item. Now, the item which is not a monetary, that would be a non-monetary item. So this non-monetary item will not be retranslated at the year end. Non-monetary items are not retranslated unless we are using revaluation model or fair value model. And for advances, there is no revaluation model or there is no fair value model. So it will be translated and recorded on the spot rate, which is 1st December X7. After that, subsequently, this advance would not be retranslated. There will be no foreign exchange gain or losses recorded on this advance payment at the year end. Okay, so that is relating to the options to buy a building, the payment which you have made as an option to buy a building. So here there were two standards were relevant. One was the IFRS 9 and other was the IS 21. Okay. Now, again, I will come back to this sheet to pass the SBR exam. And you may have may have feel it, and you have may have now more confidence that if you have did the hard work for, if you are going for the March attempt, if you have did the hard work, you are going through all the standards, does not skip a single accounting standard. Especially the accounting standard should not be skipped. You can take risk on other areas, but you cannot take a risk on accounting standard group account. Go through all the accounting standards and you get the knowledge related to transaction of the relevant standard, and through the practice, you have developed the skill to apply that knowledge on a given case study, then you are going on the right path to pass the SPR, and be confident that paper would be very easy for you. You just need to manage the time. Yes, time will be the challenge. In exam, you will have 3 hours and 15 minutes and you have 100 marks paper, and you have to do anything to complete that paper. And to complete the paper, my advice as a tutor is that just keep yourself limit within the requirement of the question. Don't go beyond the requirement. It will save a lot of time. And the candidate, the student, the mistake which they do while attempting the SBR exam, especially as we are talking about the SBR exam, the mistake which they usually do, they go beyond the requirement, which is not required. That habit waste their time in the exam, and they are not able to complete the total paper, 100% marks. Okay, so that would be my advice, that people should keep yourself limit yourself within the requirement of the question. Don't go beyond the requirement while answering the question. Okay, student. Hopefully, people will get a boost of confidence after attending this session. And best of luck for my side. Good luck for your March attempt, and may you pass with good marks. So goodbye and take care. Thank you very much.